The dollar is the most remarkable achievement in the history of money. Think of it. This piece of paper cost nothing to produce. There's nothing behind it except the goodwill of Ben S. Bernanke. And let us not forget the U.S. Congress. This piece of paper somehow still commands value and respect. How can the dollar be anything except the world's greatest monetary brand, the Coca-Cola of money? How can it be anything else but? Well, you just watch.
Since 1971, the U.S. dollar and the global financial system have been based solely upon faith. Faith in the guardian of that currency and of that system, the American Central Bank, the Federal Reserve. As the world's reserve currency, the U.S. dollar is how we measure our time, our products, our self-worth. Ours is a system based on trust and confidence, both of which began to disappear in the fall of 2007.
Plunging interest rates helped trigger the housing boom, but with interest rates climbing back, many homeowners are having a hard time paying their mortgages.
14 million people took a mortgage in the last 3 years. 7 million of them will lose their homes. This is crazy.
The Fed thought that this was a small problem. When the crisis was first talked about, this was a subprime mortgage problem. And it just kept growing and growing and growing.
Mortgages that have gone awry.
Government officials scrambling to prevent the collapse of the giant investment bank Lehman Brothers.
We are having an electronic run on the banks. The Federal Reserve's estimation was that $5.5 trillion would have been drawn out of the money market system of the United States, would have collapsed the entire economy, and within 24 hours, the world economy would have collapsed. It would have been the end of our economic system as we know it.
Congress could not act in a timely way. Therefore, the Fed felt like it was important to stabilize the economy that we do. That is not the normal role for a central bank, nor should it be.
While politicians debated, the Fed acted. It used its political independence and unlimited power to create money, to provide trillions of dollars in loans to corporations of all kinds, dwarfing the congressional aid that followed.
What people on Main Street and most politicians didn't understand is that if we didn't do something, General Electric would have pulled down, Berkshire Hathaway would have pulled down, General Motors would have pulled down, Citigroup would have pulled down Bank of America.
I mean, we came to the brink of the abyss and we looked over, and it was a long way down. The Fed really did have to step in.
And this is why the Fed was set up in 1913. To provide liquidity to the financial system as a whole at a time when you have a financial panic.
What do you know about the Federal Reserve?
Not much.
There is this perception that people have that the Fed is this kind of black box. Nobody quite understands it.
Take care of currency.
Where's some of the money?
They somehow regulate the stock market.
I think we're mysterious to people. I think they're not sure what we do.
Sounds like they're printing money. Nuh-uh.
One myth that's out there is that what we're doing is printing money. We're not printing money.
Is that tax money that the Fed is spending?
It's not tax money. It's much more akin to printing money than it is to borrowing.
You've been printing money.
Well, effectively.
What exactly is the Fed's job? It does control the money supply, set interest rates, regulate banks, and is supposed to ensure the safety and soundness of the financial system.
The Fed is supposed to be the guardian of financial stability, preventing chaos in markets. Now, usually it can do that. In the summer of 2008, it couldn't do that, and we did get chaos.
But what caused the crisis in the first place? What brought the wealthiest nation in history to its knees? According to many economists and senior Fed officials, it was the Fed itself at the eye of the storm.
The Fed kept interest rates too low for too long?
That contributed to the bubble in housing prices.
This was warned about at the time. This was textbook. When you take rates that low, you're going to have a boom, and a bust is likely to follow.
The Fed failed to prevent the housing bubble, the predatory lending scandal, and utterly failed to prevent the financial crisis.
So we failed to regulate the most important part of our financial system.
And I don't think any of us who've ever worked at the Fed take any comfort from the fact that somebody screwed up. But I think it's important we recognize there were some big mistakes made.
Didn't the Federal Reserve System fail?
I know my time has run out, but I really fundamentally disagree with your point of view.
And I think there is a natural inclination that things are fixed, but things are not fixed.
Everybody wants to go back and say, things are fine now. Look, we solved our problem. We're just asking for another crisis.
This is an experiment. We've never done this before. We've never been here before. The Federal Reserve is really operating by the seat of their pants.
So I think we need to look very carefully at what the Fed did, and perhaps even more important than looking back and blaming people is the issue of what role should the central banks play going forward as we start thinking about this is a mess and we don't want to do this again.
This isn't the first time the central bank we created to protect our economy has instead led us to the brink. The real currency of the world is trust. As that slips away, can the Fed learn from the past, and can it do it in time?
We haven't had big countries going down, unable to save their system and collapsing. That's the crisis we have to worry about.
You have what degree of confidence in your ability to control this?
100%.
There used to be a country called Great Britain. Now we call it the UK, or Britain. And Great Britain was this little tiny place that had this currency that passed for good money the world over. This currency was backed by gold. You could walk into the Bank of England and exchange your banknotes for gold at a certain statutory rate.
So the gold standard, making your money tied to a precious metal, is a way of stabilizing its value and restricting the ability to create too much paper money. But that world came crashing apart when World War I began.
To print the money needed to finance the war, the great powers of Europe abandoned the gold standard. With Britain bankrupt and German society destroyed by hyperinflation, the U.S., its new Federal Reserve, and a gold-backed currency emerged preeminent.
The Federal Reserve has the power to create money. If you or I run the printing press in our basement, we're counterfeiters. When the Federal Reserve runs the printing press, the electronic printing press, it's monetary policy.
Monetary policy is when the Fed uses its power to create or destroy money, to lower or raise interest rates. If it creates more money in the system, money becomes more available and interest rates fall, so we're more likely to borrow and spend. If the Fed takes money out of the system, we borrow and spend less and are more likely to save.
If you're raising rates, you want to slow economic activity to cool inflation. When you lower rates, you want to stimulate some economic activity.
The change in rates by the Fed is really a question of gas pedal versus brake.
In the 1920s, the Fed began to use this newfound power to steer the U.S. economy.
The Fed moved into managing the overall macroeconomy. Now, unfortunately, its first foray into that was the Great Depression. Did not do a great job.
The Roaring '20s saw the first instance of a Fed-induced boom and bust. At first, the Fed's low rates unintentionally helped fuel stock market and debt bubbles, which saw speculators borrow more money than the entire amount in circulation. An alarmed Fed then clamped down, raising rates aggressively in 1928 and setting the stage for a recession and stock market crash.
Right after the crash, the New York Fed did exactly the right thing. It provided liquidity to the New York money market. It prevented a banking panic. Now, the board in Washington, they were worried the expansionary policies that the Federal Reserve was following would lead to a reignition of speculation and an inflation. So the Fed stopped its easing policy. Well, then trouble hit the banking system, and the Fed did nothing.
As banks began to fail, people withdrew deposits and stuck them under the mattress. Now banks didn't have money to make new loans, and the economy spiraled down.
Because we were still on the gold standard, we had trouble figuring out what to do. We tried to protect our gold position, which required raising rates at exactly the wrong time.
And so instead of providing enough money to prevent prices from falling, the Fed allowed the money supply to collapse. And that's what turned what would have been a garden variety recession into the Depression.
It wasn't that the Fed deliberately created the Great Depression.
They desperately wanted to fix what was going on. They just had the wrong diagnosis. That's a view that is widely shared now. The current Federal Reserve Chairman, Ben Bernanke, has said, we did it, we being the Federal Reserve. We caused the Great Depression, and we won't do it again.
They were wrong. They learned by the pain and suffering that we all felt as a result of that. First great mistake was the Great Depression. The other great mistake was the Great Inflation.
The best things in life are free, but you can give them to the birds or bees that need money.
In the next great crisis, the problem wasn't too little money, but too much.
Money, yeah, that's what I want.
The middle of the 1960s was a very nice period.
There was no inflation, no unemployment, and a lot of self-congratulation in Washington, D.C. However, beneath the surface of things, there was trouble.
President Lyndon Johnson's Great Society programs and his massive escalation of the war in Vietnam drastically increased government spending and caused prices in the U.S. to shoot higher.
The war in Vietnam was, like all wars, the cause of a governmentally orchestrated inflation.
To protect the value of the dollar, Fed Chairman Bill Martin needed to raise interest rates, as he had done since 1951. But Lyndon Johnson was a different kind of president.
Johnson said, no, we don't want interest rates to rise. We don't want to derail the Great Society. We don't want to create a recession. We've got a war to fight. And the Fed caved in.
The results were disastrous. Vietnam and then Johnson's Great Society programs on top of that was too much demand for the economy, created this immense inflation.
And by 1971, it was clear the dollar could no longer be exchanged into gold. Finally, President Nixon, in front of a television camera,
I have directed the Secretary of the Treasury to suspend temporarily the convertibility of the dollar into gold or other reserve assets.
And that began the modern age of inflation.
For the first time in history, the dollar was just a piece of paper, backed only by faith in the Federal Reserve and its policies.
Now, what does this mean for you? Your dollar will be worth just as much tomorrow as it is today.
That promise was only as good as the Fed actions behind it. But bowing to pressure from Nixon and clinging to flawed economic theories, the Fed refused to raise rates. Over the next decade, the cost of living more than doubled, as the dollar lost more than half its value.
And by the time the 70s ended, it was a total mess.
Prices went up infamously during the Carter presidency.
People began to say, we don't want it. We won't stand for policies that create ongoing inflation.
I really hate it because you pay so much for so little.
Good evening. Prices in the United States during the first 3 months of 1979 went up at an annual rate of 13%.
The question is, how long will this go on? Inflation running out of control. The answer, probably for years.
President Carter found himself on the defensive because inflation was becoming very unpopular.
Inflation is our friend.
And that's when Carter appointed Paul Volcker.
When I was appointed by Jimmy Carter, he was kind of up against it. It was a very difficult period. People don't like to raise interest rates. It's not very popular. And there was some resistance and fear of creating a recession and so forth.
Volcker had tried to get the Fed governors to nudge interest rates upward, without success. So he tried a different tack, persuading them to focus on controlling the money supply.
And when he slowed the money growth rate, predictably, the interest rate went way up.
Neither he, nor I, nor anyone else had any idea of how high the interest rate was going to be.
8% to 9% to 10%.
15% to 18, 19, 20%.
21%. Really the highest levels in American history.
He told me, I never thought we'd have to go to 20%, but he did. That took courage.
Now, the Fed was aware that it would almost certainly produce a recession. And Volcker says, I'm going to stick with my policy, even though the recession that begins in 1981 was the longest recession in post-war history. In that period of a couple of years, the world's view, the political view of the role of the Federal Reserve and its importance in the country changed dramatically.
Had those decisions been left to politicians, it's inconceivable that they would have, quote, voted for such a deep recession to bring the inflation rate down. That's sort of a generic flaw of political systems. Ask members of Congress to vote for things that cause short-term pain for long-term benefits, and it's pretty hard. It's pretty hard to get the votes.
It's nice that we have leaders who step up and do the right thing now and then, take a long-term view. We could use more.
Paul Volcker has advised me of his decision not to accept a third term as a member and chairman of the Federal Reserve Board.
With inflation tamed, Volcker was expendable. And President Reagan would not reappoint him to a third term. But Volcker had restored faith in the dollar and in our central bank. And he'd laid the foundation for an era of unprecedented prosperity. It would be up to the next chairman to keep it alive. And for many years, it looked like he had.
It's morning again in America.
Place your left hand on the Bible and
The period from about the mid-1980s till about 2007 was an era characterized by mild recessions and measured expansions and by seeming limitless visibility. The economists called it the Great Moderation.
It reflects the idea that the Fed is on top of things and the feeling that the Fed deserves the credit, and, you know, they kind of took credit.
The economy did very well. We had rising stock market. The Cold War came to an end. Most of the world became more interested in market economies.
The economy was growing. Unemployment was low, but surprisingly at the same time, we had very little inflation.
And as a result of that, this was a golden age for the Fed. And I think there was a change in the public attitude toward the role of government.
Government is not the solution to our problem. Government is the problem.
It was in this atmosphere of faith in markets and a lack of faith in government that Alan Greenspan, a free market advocate who mistrusted government, was chosen to lead the government's most powerful agency.
Greenspan, as is widely known, was in the day a disciple of the radical individualist Ayn Rand.
I am for an absolute, laissez-faire, free, unregulated economy. If you separate the government from economics, you will have peaceful cooperation and harmony and justice among men.
One of the great ironies of his career and of our national life, Greenspan, the so-called Ayn Rand guy, became the chief price fixer of money.
Greenspan's first test would come immediately. In the last 5 years, the U.S. stock market had more than tripled in value as a result of falling interest rates, low inflation, and a rediscovered faith in American capitalism.
The point is, ladies and gentlemen, that greed, for lack of a better word, is good.
Though greed wasn't new to Wall Street, the means for satisfying it were. For the first time, the market was making widespread use of complex financial products like derivatives.
This has been the worst day ever in the history of the New York Stock Exchange. The Dow off more than 500 points. Paper losses more than $500 billion.
The fear in the market quickly spread, and so the Federal Reserve lowered rates very rapidly, provided liquidity very openly.
Alan Greenspan handled that event very successfully, reassured the markets, eased monetary policy.
You say, this is really good. This is why you want this monetary policy to be the way it is. And so there was a lesson there. You can intervene, you can end the crisis.
It was a historic moment, but it came with a dangerous precedent. From now on, the Fed would be expected to lower rates based not just on problems in the real economy, but in the stock market as well.
Fed Chairman Alan Greenspan didn't want to see any regulation of banks, of markets. And on the other hand, he's pulling switches and moving levers and, more than any Fed chairman before or since.
Having cast aside his ideals to rescue the market, Greenspan would soon master the art of intervention. What followed was the longest economic expansion and largest stock market boom in U.S. history. An economist with no prior banking experience had become the maestro.
Well, I was on the Fed from around the middle of 1994 until 1996. I was vice chairman. Now, that's not as high a job as it sounds when Alan Greenspan is the chairman.
We all know that when Chairman Greenspan talks, the world listens.
By the time all those things had happened, Alan Greenspan was about as close to God as one can come and still be on this earth. First of all, nobody should ever be deified, because none of us is God. That did happen to Greenspan, and one corollary of deification is people think you know, and people think you'll always get it right. The concrete manifestation of that inside the Federal Reserve is that it became very hard to criticize Greenspan in any way. I mean, who wants to stand up to God?
But playing God with the business cycle had consequences, and the Fed soon faced a new challenge and a new kind of inflation.
A kind of inflation that we have learned to call asset inflation. That is, prices not of goods going up, but of stocks, bonds, real estate, and other investment assets going up. On Wall Street, that is known as a bull market, and everyone is for it.
We've never had in this country a period when the stock market was going up 15% a year for a sustained period of time, and people thought that was going to continue.
Everybody loves a boom. Who's there who dislikes it?
But Greenspan was concerned that the boom was really a bubble. But the markets refused to listen, and instead turned on the messenger.
People were saying, have your chairman stay out of our business. Don't talk down the stock market.
So Greenspan, who likes to be liked of almost all other things, gave this up, this idea that the stock market was too high, and instead began to cheer it on.
Greenspan would never again lean against the wind of popular opinion. As stocks soared to record heights, he refused to use his power to cool overheated markets, and would instead intervene aggressively at the first sign of weakness.
Investors were rocked by the near collapse of a huge financial operation.
Long-term capital management was a large hedge fund run by some very smart people, but they guessed wrong.
The U.S. Federal Reserve arranged for a $3.5 billion bailout by long-term creditors.
So this alleged libertarian was presiding over the socialization of risk in our economy. It's perfect.
So we're not a free market then? There is an invisible, there's a benevolent hand.
No, that's the way it comes out, but that's not the way we think about it.
Greenspan was acting in ways his predecessors never had, so much so that Wall Street gave it a name, the Greenspan put.
So the Greenspan put is the idea you can take any risk and you can, in effect, put it to the Fed.
Look, if the market gets too far out of hand, I'll rescue you. That's essentially how traders interpret it.
In other words, it's a backstop. It's something under you that supports you in adverse times.
And when you rescue people from their own behavior, well, then they're more likely to engage in riskier and riskier behavior.
The Fed thought it could protect the market with easy money. But its promise of a safety net unleashed a surge of borrowing, debt, and risk. It would not just transform the economy, but distort it. During Greenspan's reign, the financial sector would double its share of the economy. Companies that once sold products would now sell loans.
General Electric essentially was a hedge fund. General Motors, et cetera, car companies, they didn't make money selling cars, they made money financing cars.
And firms that had once worked in service to their clients now make enormous profits trading for themselves, engineering ever more exotic financial products like derivatives, which, unlike traditional assets, were bought and sold in secret and left completely unregulated.
Financial derivatives have grown at a phenomenal pace and have contributed to the development of a far more flexible and efficient financial system.
Despite the fact that derivatives lay at the heart of both the '87 crash and the LTCM bailout, Greenspan resisted any attempt to regulate them.
I am very concerned that we will put in place a set of new forms of government regulation of all sorts which will not work.
Greenspan's ideology won out, and 10 years later, the U.S. taxpayer would spend over $182 billion bailing out insurance giant AIG's unregulated derivatives unit.
The smart folks that run the financial markets are so skillful that they can take care of all these problems themselves. That sounds like a caricature, but people really believe that. Lots of people really believe that, and some of them were running major regulatory agencies, such as Alan Greenspan.
The Fed was offering the markets an amazing deal. No regulation to prevent you taking risk, but if your bets went wrong, lower interest rates to rescue you. U.S. stocks soon became more overvalued than at any other time in history.
Stocks got to just astronomical levels. People were forming new companies without any business plans, and investors were giving them money. It was absolutely ridiculous.
We were worried about that at the Fed, and we talked about it a lot. Should we raise interest rates in an attempt to prick the bubble before it got too bad, or not? And we decided not.
While bubbles that burst are scarcely benign, the consequences need not be catastrophic for the economy.
3 months after the ball dropped, so did the stock market. The dot-com collapse and 9/11 attacks put to the test Greenspan's view that bubbles could be cleaned up afterwards. And he quickly responded with a series of interest rate cuts to soften the blow.
There was a big fear after 9/11 that we were headed for a huge recession. That didn't happen.
So I think the people who held this view coming through the 2000 bubble collapse felt very vindicated that it was a reasonable approach.
If this is the bust, the boom was sure as hell worth it. You agree with that, right?
Certainly.
It looked like Greenspan had done it again, but there was a catch. The Fed had softened the dot-com crash with aggressive interest rate cuts, and now those same cuts set off another boom.
Lower rates mean lower mortgage payments, which created an unsustainable bubble in housing.
In today's struggling economy, many Americans have taken refuge by investing in the real estate market. The Fed says the housing market is solid, but others say there's reason for caution.
Housing doesn't easily bubble. Homeowners are not looking to speculate anywhere near the degree of stock investors. So you have to try. And the Fed did precisely that.
So we ended up encouraging a housing boom. We, being the Federal Reserve, ended up encouraging a housing boom. I will continue to defend those decisions because we had no employment growth after the bottom of the recession.
The extraction of equity from homes has been a significant support to consumer spending. Were it not for this phenomenon, economic activity would have been notably weaker.
And the Fed proceeded to press down this rate of interest it controls, the so-called federal funds rate, all the way down to 1%. You could scarcely see it was so tiny.
And part of that was intentional on the part of the Fed to get us all to take more risk than we would otherwise take.
I love that house, plus the schools.
The kids are 3 and 1.
They're gonna grow up. What?
This listing is special, John. You guys can do this.
We can do this.
Okay.
Are you kidding me?
By lowering the price of money, the Fed was raising the prices of things bought with borrowed money.
We favored real estate, for example, because we didn't want to see people out of jobs. Well-intentioned, but the consequences are we created the incentives to borrow. And we brought households to debt levels that no one would have imagined 20 years ago, not just 50 years ago.
President Bush signed a housing bill, which was part of his ownership society, and he said how good it was that people had houses.
New home construction, the highest in almost 20 years. Home ownership rates, the highest ever.
But they didn't have any investment in the house. They didn't have any equity in the house. So what did they own? They didn't own anything. They owned a mortgage, which if things got bad, they could default, and they did.
Now, there are a lot of people who want to criticize the American household for being dumb.
Americans borrowed too much, in part because they did not understand how to save prudently, how to borrow responsibly, and they did not understand fully that pension values and house prices will not always rise.
I think that's mistaken. I think I would never short the intelligence of the American consumer. Sort of the collective wisdom, I think, is usually pretty good. We gave them really low interest rates in 2003, 2004. Guess what? They borrowed a lot of money.
So it looked like the Fed had done a great job, and they were kind of patting themselves on the back.
There appears to be enough evidence that our strategy of addressing the bubble's consequences, rather than the bubble itself, has been successful.
It was not a good year for optimistic predictions.
You know, the way a healthy economy grows is people earn money and they go out and spend it. The way an unhealthy economy grows is people borrow money and they go out and spend it.
The Fed's low rates helped spur a doubling of mortgage debt, turning the American dream into a tragedy for millions of families. But the real borrowing spree didn't happen on Main Street. Seduced by the same low rates, the world's biggest banks jumped at the chance to multiply their profits with massive borrowing of their own, or as they say on Wall Street, with leverage.
And this is where the real egregiousness in interest rates manifests itself.
The Federal Reserve's main policy interest rate was only 1%. The big banks lend that money out on a mortgage at 5 or 6%. Now, if I can borrow money at 1% and lend it out at 6%, I'm going to make a tremendous profit from that. That was the problem with the low interest rates. Financial institutions borrowed too much, became careless in the lending they did.
Able to borrow money for nothing and earn huge fees for lending it out, Wall Street began simply giving money away.
You know, firms like Lehman Brothers borrowed at those low interest rates, made mortgage-backed securities on the base of it, and spread it around the world.
A growing family with a lot of debt, a young couple with no down payment, a business owner whose income was hard to document. Every one of them was turned down for a home loan by 3 different lenders. I'm with Countrywide, and I got them all approved.
Now, the Fed didn't do that. The banks did that, but the Fed could have and should have prevented these crazy mortgages from being granted.
The Fed could have cut off the speculation quite easily, but the atmosphere in Washington then was quite the opposite.
We have an excessive concern about home ownership and its role in the economy. This is not the dot-com situation. Homes that are occupied may see an ebb and flow in the price, but you're not going to see the collapse that you see when people talk about a bubble.
To set standards for mortgages would have been going straight against the political environment. The Federal Reserve would have been pretty brave. They should have, in retrospect.
The Fed had unique authority to regulate all mortgage lenders. It finally used it in 2008. They could have stopped the subprime unit of Lehman.
You had the authority to prevent irresponsible lending practices that led to the subprime mortgage crisis. You were advised to do so by many others, and now our whole economy is paying its price.
As Alan Greenspan's term drew to a close, his transformation of the American economy was complete. A financial sector of outsized proportions, housing bloated by borrowing, a dismantled regulatory system, and a collective delusion that all was well.
Where do you think you made a mistake then?
I made a mistake in presuming that the self-interest of banks and others was such as that they were best capable of protecting their own firms.
They just assumed that this is what the private market was doing, and the people in the private market knew what they were doing.
That still leaves open the question, which I think historians are going to be looking at for a very long time. Suppose Greenspan and the Fed had this belief. Why did not the events as they were transpiring shake that belief?
One of a president's most important appointments is chairman of the Federal Reserve.
My first priority will be to maintain continuity with the policies and policy strategies established during the Greenspan years.
As a Fed governor, Ben Bernanke had spent the peak years of the housing bubble promoting his mentor's easy money and lax regulation. Taking over the helm, he had no idea he would reap what he'd sown.
We have so many economists coming on our air and saying, oh, this is a bubble and it's going to burst. What is the worst case scenario if, in fact, we were to see prices come down substantially across the country?
Well, I guess I don't buy your premise. It's a pretty unlikely possibility. We've never had a decline in house prices on a nationwide basis. So what I think is more likely...
What Bernanke should have said is, it has never declined because it's never had a bubble before. Robert Shiller's data shows 100 years of incredibly flat price series, followed by suddenly a Himalayan mountain going up very rapidly in 3 years. Bernanke is the perfect academic. He's not looking at house prices. He so profoundly believes in market efficiency that there can't possibly be a housing bubble, so why bother to look for it?
The Bernanke Fed really blew it. They just didn't see it coming.
The problems in the subprime market seems likely to be contained.
So the magnitude of what was to come down the road was completely discounted. And then, at some moment, people realized they really overextended themselves.
Stocks crushed today.
Financials hit really hard. Bank of America down 40%. One of the worst days ever on
This
Wall
is a
Street.
market driven by fear.
Alan Greenspan told everyone to take a teaser rate, and Bernanke is being an academic. He has no idea how bad it is out there. He has no idea.
As the crisis unraveled, the Fed only dimly perceived its true dimensions. It was a bank run, but one that bore no relation to those of the past, involving not just the banks the Fed was created to protect, but the hedge funds, investment banks, and insurance conglomerates the Fed had allowed to hide from its oversight.
Company's called AIG. It's in big trouble. They need money, which nobody has to give right about now.
The failure of AIG would have meant a run on the 50 largest banks in the world. They would not have survived the capital hit.
We saw what happened when 1 or 2 large firms came close to failure. Or imagine if 10 or 12 or 15 firms had failed, which is where we almost were.
You have to have credit to operate, whether we kept rates too low for too long. That's history. Confronted with a situation where the heart stopped pumping, we had to be the pacemaker and make it work again.
American taxpayers woke up this morning to learn their money makes up a bailout package the Federal Reserve slammed together to save AIG.
Over the course of the crisis, the Fed would pump trillions of dollars in emergency loans to banks, corporations, and governments around the world. Though the moves were a logical extension of the Fed's ideology, they were unprecedented.
Are you committing in this interview that you are not going to let any of these banks fail? That no matter what their balance sheet actually looks like, they are not going to fail?
They're not going to fail.
Bernanke single-handedly stopped the run. But when his bailout failed to jumpstart recovery, the Fed upped the ante. With interest rates already at zero, the Fed's only way to juice the economy was to print more money, with a technique called quantitative easing, or QE. Beginning in 2009, the Fed purchased over $1.3 trillion of mortgages and debt from failed lenders Fannie Mae and Freddie Mac. It was a temporary nationalization of the mortgage market. What followed was the single biggest stock rally since 1932. And when markets faltered in 2010, the Fed announced a second round, QE2. If the Greenspan put had been whispered, the Bernanke put was now loud and clear.
Hedge fund heavyweight David Tepper raked in a record $7.5 billion by investing in financials. How did you do it in 2009? What did you see?
It was easy. The government told you what they were going to do.
So QE2
they said they want the market up. Okay, so what am I? I'm going to say, no, Fed, I disagree with you. So what I got is I got 2 different situations. One, that the economy gets better by itself. The other situation is the Fed comes in with money. You know, up to the point the Fed comes in with money, the stock market can go down a little bit, but not that much because I got a put. You got to love a put, especially when the government's issuing it.
Bernanke had saved the system, or had he? It was still riddled with the same bad loans and institutions too big to fail, only now spared from the free market's law of survival of the fittest.
We're at a point now where the consumer is in no position to keep borrowing. Banks are in no position to lend. The banking system is still, in my opinion, insolvent. It's still broken.
Ben Bernanke has led the Fed through one of the worst financial crises that this nation and the world has ever faced.
The Great Moderation began as an homage to the free market, but today it could not be further from that ideal. The 2 chairmen, appointed by both Republican and Democratic presidents, created an economy more centrally planned than ever in our history. One entirely dependent on ever cheaper credit from our central bank.
From 20% to 0, drops in interest rates bailed out investors in any number of transactions. Every time the response is more debt fueling the growth.
But while this mountain of debt provided rocket fuel for housing and finance, overall growth actually slowed. As more of our resources and many of our best minds pursued not medicine nor engineering, but the zero-sum game of financial speculation.
Creating financial transactions is not production. It does nothing to your standard of living, except for a few people who are able to work at a bank, watch their stock price go up, sell the stock, and then they have the wealth. But they have to sell the stock in order to do it.
So understand what happens when stock prices go up. The same with housing. It doesn't make us better off. It helps those people who own stock and it hurts people who don't own stock.
You know, tremendous wealth was created in financial markets, which didn't seem to be paralleled by any great improvement in the economy and in the incomes of other people.
And so what we see as this increase in wealth is actually just a redistribution to those who own wealth, away from those who don't. So you have an illusion of wealth. Certain people at the Fed bought into that.
I've always believed we underestimate the impact of stock prices on economic activity. I don't know where the stock market is going, but I will say this, that if it continues higher, this will do more to stimulate the economy than anything we've been talking about today or anything anybody else is talking about.
But for all the booms, bailouts, and easy money, since 2000, no net jobs have been created in the U.S., and per capita growth in the private sector has been stuck at zero.
So it is not working. And all one can say with respect to this current crisis is, here we go again.
The Federal Reserve today announced plans to buy $40 billion of mortgage bonds a month until further notice.
Bringing interest rates down, it affects stock prices, it affects home prices. If people feel better because their 401k looks better and their house is worth more, they're more willing to go out and spend.
But can a problem created by money for nothing really be solved by ever more of the same?
The major banks are racking up profits, and yet lending to small businesses actually declined in the third quarter.
Somebody's paying the price for low interest rates. It's you and me who have money market accounts which are earning 0.27%. I mean, I worked to save that money. And now, in one swoop, the Fed decides I get nothing for that money in order to bail out the banks. That, to me, is outrageous.
It is no longer just outsiders who criticize Bernanke's efforts to play the hero for financial markets.
Printing money doesn't produce goods and services. It doesn't hire people. It may seem like the right short-term medicine, but can the cure be worse than the disease in some cases?
We can borrow tons and tons of money at very low interest rates, and we can continue to do that for some time. The problem comes in the long run. How long is this going to last? When is this game going to end, and how is it going to end?
Free of the gold standard's restraint, the only limit on our government's ability to borrow and print is the confidence people around the world place in our IOUs.
It's a first in our nation's history, cutting the country's top AAA rating to AA+.
But how long can a dollar-based system last if we take that confidence for granted?
The United States can pay any debt it has because we can always print money to do that. So there is zero probability of default.
How can the dollar be anything except the world's greatest monetary brand, the Coca-Cola of money? How can it be anything else but? Well, if you produce enough of these green pieces of paper, if you throw around your weight too far as the world's one and only superpower, bad things happen.
For years, the country lived beyond its means.
It's clear that easy money has been no kinder to governments than it was to homeowners. And while the U.S. nation, however powerful, is too big.
The mother of all crises. Big countries going down, unable to save their system and collapsing, that's the crisis we have to worry about.
The time to have made good choices was back in the 90s and the early 2000s. And we didn't make good choices as a country, as an American polity. And now we're faced with a number of bad choices. But if we fail to make the uncomfortable choice today, we're going to create even more uncomfortable choices down the road.
times have you heard someone say, if I had his money, I would do things my way?
You know, at some point over the last 20 years, we seem to have lost sight of who we are, and we were more concerned with the types of houses we lived in and the speed of the cars that we drove.
The United States has consumed more than it's produced systematically for at least a decade. What country, ask yourself, in history can do that indefinitely, forever?
The government and the Federal Reserve are continuing to encourage people to spend their money. That is not a stable economy.
So in other words, the U.S. economy probably won't grow as fast as possible, but that's fine if we can learn to be happy with what we have, as opposed to the system fully designed around getting people to want more than what they have, and they're unhappy unless they have that more.
Little they know that it's so hard to find one rich man in 10 with a satisfied mind.
Now, the interesting question is, when you've been on that path that long and the imbalances have grown up that big, what's the process for getting off the bad path onto a better one?
You got to create something the world wants. And that's what we've got to get back to in the United States.
What drives long-term growth is the real world, education, capital spending, the quality of your workers. They're the things you should worry about.
We're still the largest exporter in the world. We have the human capital, the knowledge. We need to just have the incentives.
Somehow we need to go to an economy that is using its resources, operating at full employment, but doing so in a way that isn't reliant on bubbles anyplace, that is a solid, responsible use of resources.
That means you need to have interest rates that don't discourage savings.
Less subsidies for housing,